The global financial system is often presented as a complex web of institutions working together to maintain stability, facilitate investment, and support economic growth. Banks, regulators, governments, and central banks form the backbone of this system, and under normal circumstances, their operations remain largely invisible to ordinary citizens. However, during times of crisis, the inner workings of this system suddenly become visible, and the decisions made by policymakers can have enormous consequences for taxpayers, businesses, and entire economies. One of the most controversial examples of this dynamic occurred during the global financial crisis of 2008, when governments around the world used public funds to rescue struggling financial institutions. These bailouts were justified as necessary to prevent economic collapse, yet many critics argue that they ultimately allowed the very institutions responsible for the crisis to emerge even more powerful and profitable than before. To understand how this situation developed, it is necessary to examine the financial environment that existed in the years leading up to the crisis. In the early 2000s, banks and financial firms dramatically expanded their involvement in complex financial instruments tied to the housing market. Mortgages were bundled together and transformed into securities that could be sold to investors around the world. These products, known as mortgage-backed securities, were often packaged into even more complex structures such as collateralized debt obligations. Financial institutions believed these instruments could spread risk across the global financial system while generating significant profits. However, many of the mortgages underlying these securities were issued to borrowers who had limited ability to repay them. Large banks such as Goldman Sachs, Citigroup, and Bank of America became deeply involved in the creation, trading, and financing of these mortgage-related assets. As housing prices rose rapidly, the entire system appeared highly profitable. Investors, pension funds, and insurance companies eagerly purchased these securities because they were often rated as safe by credit rating agencies. The perception that housing prices would continue rising indefinitely created a sense of confidence that masked the growing fragility of the financial system. The situation began to unravel when housing prices started to decline in the mid-2000s. As homeowners struggled to repay mortgages, defaults began to rise. Because these mortgages had been packaged into securities and sold across the global financial system, losses quickly spread from one institution to another. Banks that had invested heavily in mortgage-backed assets suddenly faced massive write-downs. Financial markets became increasingly unstable as investors realized that the value of these securities was far lower than previously believed. The collapse of Lehman Brothers in September 2008 marked a turning point in the crisis. Lehman's bankruptcy triggered panic throughout global financial markets, as institutions feared that other banks might also fail. Credit markets froze, making it difficult for businesses and consumers to access loans. Stock markets plunged, and the global economy entered a severe recession. Policymakers faced a stark dilemma: allow failing banks to collapse and risk a complete breakdown of the financial system, or intervene using public funds to stabilize the institutions at the center of the crisis. In the United States, the government responded by launching the Troubled Asset Relief Program, commonly known as TARP. This program authorized hundreds of billions of dollars in government funds to support banks and other financial institutions. The goal was to restore confidence in the financial system by providing capital to struggling banks and purchasing distressed assets from their balance sheets. Similar rescue programs were implemented in many other countries as governments attempted to prevent widespread bank failures. Supporters of these bailouts argued that they were necessary to prevent an economic catastrophe. Modern economies depend heavily on functioning credit markets. If banks fail on a large scale, businesses cannot obtain financing, consumers cannot access mortgages or car loans, and economic activity grinds to a halt. From this perspective, rescuing major financial institutions was seen as the only way to stabilize the system and protect millions of jobs. Central banks, such as the Federal Reserve, also took unprecedented steps by lowering interest rates and providing emergency liquidity to financial markets. Despite these justifications, the bailouts quickly became highly controversial. Many citizens were outraged that governments were using taxpayer money to rescue institutions that had played a central role in creating the crisis. While banks received massive financial support, millions of homeowners faced foreclosure as housing markets collapsed. Unemployment rose sharply, and many families struggled to recover from the economic downturn. Critics argued that the bailout system effectively privatized profits during the boom years while socializing losses during the crisis. One of the most striking outcomes of the bailout programs was how quickly many large banks returned to profitability after receiving government support. Institutions that had appeared on the verge of collapse were soon reporting strong earnings again as financial markets stabilized. Executive compensation at major banks also rebounded rapidly, reigniting public anger about the perceived lack of accountability within the financial sector. To many observers, the crisis seemed to confirm that certain financial institutions had become too big to fail, meaning that governments would always rescue them to prevent systemic collapse. The concept of institutions being too big to fail has profound implications for the functioning of financial markets. When investors believe that governments will rescue large banks during crises, those institutions may enjoy lower borrowing costs because lenders assume they are effectively backed by the state. This implicit guarantee can encourage banks to take greater risks, knowing that losses may ultimately be absorbed by taxpayers if things go wrong. Economists refer to this phenomenon as a moral hazard, and it remains one of the central criticisms of the bailout system. In the years following the financial crisis, governments attempted to address these concerns through new regulations designed to strengthen the stability of the banking system. In the United States, lawmakers passed the Dodd-Frank Wall Street Reform and Consumer Protection Act, which introduced stricter capital requirements, enhanced oversight of financial institutions, and new mechanisms for resolving failing banks without using taxpayer funds. Similar regulatory reforms were implemented in other countries as policymakers sought to reduce the likelihood of future crises. These reforms have improved the resilience of many banks by requiring them to hold larger financial buffers against potential losses. Stress tests conducted by regulators evaluate whether banks could survive severe economic downturns without collapsing. However, critics argue that the financial system remains vulnerable because large institutions continue to dominate global markets. The consolidation of the banking industry during and after the crisis actually increased the size and influence of some of the largest financial firms. Another important aspect of the bailout debate involves the role of central banks in supporting financial markets. During the crisis and its aftermath, central banks implemented unconventional policies such as quantitative easing, which involved purchasing large quantities of government bonds and other financial assets. These policies were intended to lower long-term interest rates and encourage lending and investment. While they helped stabilize markets, they also contributed to rising asset prices, benefiting investors and financial institutions that held large portfolios of stocks and bonds. The long-term effects of these policies remain the subject of intense debate among economists and policymakers. Some argue that aggressive monetary intervention prevented a deeper depression and supported economic recovery. Others contend that these measures disproportionately benefited wealthy investors while doing less to address underlying economic inequality. The perception that financial institutions received preferential treatment during the crisis has fueled broader public skepticism toward the banking system. Public frustration with bailouts also played a significant role in shaping political movements in several countries. Protest movements emerged to challenge what many people saw as an unfair economic system in which powerful financial institutions were protected while ordinary citizens bore the costs of economic downturns. These sentiments influenced debates about economic policy, financial regulation, and the role of government in managing crises. At the same time, defenders of the bailout programs emphasized that the ultimate goal was to protect the broader economy rather than individual banks. If the financial system had collapsed entirely, the consequences for employment, savings, and economic stability could have been far more severe. Policymakers faced difficult choices in an environment where the risks of inaction appeared catastrophic. From this perspective, the bailouts were less about rescuing banks and more about preventing a systemic breakdown that could have affected millions of people. Even so, the legacy of the bailouts continues to shape public attitudes toward finance and government policy. The crisis revealed how deeply interconnected modern financial institutions are, and how quickly problems in one part of the system can spread globally. It also highlighted the enormous influence that large banks wield within the global economy. While regulatory reforms have strengthened oversight in many areas, debates about fairness, accountability, and systemic risk remain unresolved. The lessons of the financial crisis continue to influence how governments prepare for future economic shocks. Policymakers are increasingly focused on building mechanisms that allow failing institutions to be resolved without requiring massive taxpayer-funded bailouts. At the same time, the financial system itself continues to evolve as new technologies, digital currencies, and alternative financial platforms emerge. Ultimately, the story of bank bailouts raises fundamental questions about the relationship between financial institutions, governments, and citizens. Modern economies depend on stable banking systems, yet the concentration of power within large financial institutions can create tensions between private profit and public responsibility. The challenge for policymakers is to ensure that financial markets remain dynamic and innovative while also protecting the broader public from the consequences of excessive risk-taking. More than a decade after the crisis, the debate over bailouts remains a powerful reminder that economic policies are not just technical decisions made by experts. They are choices that shape the distribution of wealth, opportunity, and security within society. Whether future crises will be handled differently remains uncertain, but the events of 2008 ensure that the relationship between taxpayers and the financial system will remain a central issue in economic discussions for years to come. In the years after the immediate crisis faded from headlines, economists and investigators began analyzing exactly how bailout money flowed through the financial system and who ultimately benefited the most. The results revealed a complicated picture. Some bailout funds were technically repaid to governments with interest, which supporters of the programs often cite as proof that taxpayers were not permanently burdened by the rescue packages. However, critics argue that focusing only on repayment misses the larger economic reality. Many of the largest financial institutions regained stability because the government stepped in during their most vulnerable moment, effectively absorbing enormous risks that private investors were unwilling to take. Without that intervention, several major banks might have collapsed entirely, wiping out shareholders and executives while forcing the financial system to restructure in a much more dramatic way. One major element of the rescue effort involved restoring confidence in the banking system itself. When depositors fear that banks may fail, they often rush to withdraw their money, creating what is known as a bank run. Even financially healthy banks can collapse under these conditions because they do not keep all deposits in cash. Most of that money is lent out or invested. During the financial crisis, governments moved quickly to guarantee deposits and reassure the public that the banking system would remain stable. In the United States, the Federal Deposit Insurance Corporation played a central role in maintaining trust by guaranteeing deposits within insured limits. This assurance prevented widespread panic among depositors and helped stabilize the system during one of the most volatile periods in modern financial history. While these measures prevented catastrophic collapse, they also reinforced the perception that large financial institutions operate under a special safety net. Smaller banks and businesses rarely receive the same level of government support during economic downturns. Many small companies went bankrupt during the recession that followed the crisis, and millions of workers lost their jobs. Yet the largest financial institutions were able to continue operating with the assistance of public funds and emergency lending programs. For many observers, this imbalance raised fundamental questions about fairness and accountability in modern capitalism. Another area of controversy involved the housing market itself. The financial crisis was triggered largely by the collapse of mortgage lending practices and the rapid decline in home prices. Millions of families faced foreclosure as they struggled to keep up with mortgage payments on homes that had suddenly lost significant value. Governments did introduce programs designed to help homeowners refinance or modify their loans, but these efforts were often criticized as slow, complicated, and insufficient. Compared with the speed and scale of support provided to large banks, assistance for struggling homeowners appeared limited. This contrast helped fuel a widespread narrative that the financial system protects powerful institutions while leaving ordinary citizens to bear the consequences of economic crises. Even when banks returned to profitability, many communities were still dealing with long-term damage caused by unemployment, lost savings, and declining property values. Economic recovery was uneven, with wealthier households benefiting more quickly from rising stock markets and asset prices. The role of financial markets in shaping this recovery also became a subject of intense debate. After the crisis, central banks implemented extremely low interest rates to encourage borrowing and investment. These policies made it cheaper for banks and corporations to access capital, which helped stimulate economic activity. However, low interest rates also pushed investors towards stocks, bonds, and real estate in search of higher returns. As a result, financial markets experienced a strong rebound, and asset prices rose significantly during the years that followed. Large financial institutions were particularly well positioned to benefit from this environment. With access to cheap capital and government-backed stability, banks expanded trading operations, investment services, and lending activities. Many institutions reported record profits within a few years of the crisis. Meanwhile, executive compensation packages at major banks once again reached levels similar to those seen before the financial meltdown. For critics of the bailout system, these developments seem to confirm that the financial industry had not fundamentally changed its behavior. Another important development during the post-crisis period was the increasing concentration of power within the banking sector. Some institutions that survived the crisis absorbed weaker competitors or acquired assets from failed banks. This consolidation made the largest financial firms even bigger than before. Institutions such as J.P. Morgan Chase and Wells Fargo expanded their market share and influence across multiple areas of the financial system, including investment banking, asset management, and consumer lending. Despite these reforms, many economists believe that the fundamental structure of the financial system still contains vulnerabilities. Financial innovation continues to create new products and markets that regulators may struggle to fully understand or monitor. The rise of complex derivatives, algorithmic trading, and global investment networks means that risks can spread rapidly across borders and institutions. Even with stronger regulations in place, the interconnected nature of modern finance makes it difficult to eliminate systemic risk entirely. More than a decade after the crisis, the memory of bank bailouts remains a powerful example of how economic decisions can reshape the relationship between governments, corporations, and citizens. For many people, the experience reinforced a belief that the financial system operates under rules that differ from those applied to ordinary businesses and workers. Whether future reforms will succeed in addressing these concerns remains uncertain, but the lessons of the crisis continue to influence economic policy and public debate around the world.